Hey guys, this is Nick with Miguel Brokerage here. Let's go ahead and get started. It's a little after 1:20 here. I wanted to give everybody a couple minutes to get signed in case anybody was late. But thanks for joining us today. Today I have Jeremy Verizer with One America, and One America is one of our prime partners in regards to the long-term care market, whether that's hybrid policies or standalone policies. And Jeremy and I were talking, and I asked him if he'd be willing to put on a brief webinar and kind of give the ins and outs and a quick overall view of the long-term care market. One thing that we'll be talking, or I'll be following up with at the very end of this webinar, is we are planning on doing something early in 2018, a 4-week webinar series that's really going to dive into the ins and outs of 4 different types of long-term care options that you have available to you. With that being said, Jeremy, are you there?
Yes, sir, I am.
I will turn it over to you, and you can go from here.
All right. Thanks, Nick, and thank you all for taking time out of your afternoon here. Again, as Nick mentioned, this short 15 minutes, really the goal is to kind of give you an idea why, for the first time in years, we've seen long-term care sales actually increase. It was kind of one of those scenarios where there's been a lot of turmoil and negative press, but what we call asset-based LTC, you may also hear referred to as linked benefit or hybrid solutions, are what they accredit the main reason why these sales are beginning to increase. And so the goal is to kind of just give you an idea of how the agents and advisors who are successfully incorporating this into their practice, how they're positioning it, and give you a high-level understanding at One America of some of the competitive advantages that only we have, and the reason why we currently are number one in the brokerage arena for issued policies and sales numbers. So a little bit about One America. If you don't know who One America is, I won't spend too much time for purposes of our short webinar, but we are an A+ rated carrier with AM Best. We're a mutual company based out of Indianapolis, Indiana. For those of you that pay attention to Comdex, which we find more and more agents and advisors are, it simply just compares you against your peers with your ratings. We're 95 out of 100. Really, I think the powerful part of this story, besides the fact that we're mutual and we've been around for a long time, is that we created this concept in 1988. So we've been doing this for nearly 30 years, folks. So it really gives us a strong track record and history of pricing and managing the product and the claims throughout this. So it's not something we just started doing last year. And if you think about long-term care, the industry in general, we went from well over 100 carriers offering traditional long-term care insurance down to just a handful because there was issues with lapse ratios and the pricing that they had incorporated and built around that, as well as the future cast of where they would end up, making what percentage of interest over the duration of that policy's life while the client paid premiums. And, long-term care insurance, we believe, at least at One America, it'll always have its place. But the simple fact is we're now in a position where we have the largest segment of our population moving into retirement, yet less than 10% of these baby boomers and people entering retirement own a long-term care insurance policy. So it's an enormous challenge for us all, but it comes with great opportunity because, chances are your clients have not heard a story that revolves around simply earmarking what they would already be self-funding to use for care anyhow, gaining and picking up tax advantages. It's still their money, yet if they don't need it, it can double as either a cash value of an annuity or a leveraged life-death benefit, but most importantly, be able to cover 1 or 2 individuals with unlimited lifetime LTC coverage. So it's just a great story to tell. And for us in particular, we've found really that long-term care is not just about statistics, facilities, et cetera. Really what it is it's just another retirement expense that causes somebody's income to suddenly skyrocket. And my guess is if you were to ask your average client, look, what are the largest concerns you have entering retirement? Most folks, their number one answer is outliving their income. And shortly behind that, they won't come out and say long-term care, but they'll say an unexpected health issue. And so that's really what we're here to do is address that unexpected health risk, but provide benefits should that not happen, and speak to your clients in a manner that they speak to you, which is to say income, expenses, cash flow, return. And so that's kind of what I'm hoping to give you a high level glimpse of today. So if you think about long-term care insurance, it's not all the stuff the industry's tried to, completely beat into us, which is 2 of 6 ADLs, COLAs, months, average months. It's simply that stream of income that is going to kick in when and if, God forbid, their income needs do skyrocket due to that. So one of the questions that a lot of the agents and advisors will start with when they're talking to their clients about this is, hey, Mr. or Mrs. Jones, for example, during retirement, what could you imagine would be like a reason why your income needs would suddenly skyrocket? What could you imagine could happen? And most folks, if presented this, would say some sort of health issue. And so we're going right down the right path. So the question then becomes, where are we going to go? Long-term care, that's the gap. That's the great income gap. It's not that long-term care is an asset issue. It's really an income issue. And what are we going to start to liquidate? What are we going to start to draw upon? So when you look at what we do here at One America, all we do is what we refer to as asset-based LTC. And within that, we really only have 2 solutions. We have a life chassis and we have an annuity chassis. And then those can be funded in several different ways. So, this also does double duty by protecting you as the agent and the advisor, because not only does it ensure your clients are protected, but if you are managing assets or get any sort of residuals, this is going to help protect your interest as well and increase the likelihood that when there's the generational potential shift in assets that you can beat the odds and maintain those assets when the kids, for example, saw what a great job you did covering that risk that nobody ever thinks they're going to need, but unfortunately it does happen a lot, right? So how are you going to generate this income stream for them if they're currently self-funding like the vast majority of Americans are today? And that's really what we do is we say, hey, look, we got a couple of ways to go about this. One, we can just simply earmark whatever we would start to tap today that we would use to generate that income. So we can either earmark that lump asset, or we can make a plan to build an asset so we pay into something over time with premiums that are guaranteed to never increase. Meanwhile, building an asset so that way if we need it, it's there with lifetime coverage. If we don't, it doubles as a cash value and a death benefit, for example. So that's kind of the idea, is just to help you and get your clients understanding that right now they are the ones funding that. There's a lot of misconception that the government, that Medicare covers long-term care insurance. A lot of folks don't understand what it even takes to qualify for Medicaid, nor does that guarantee them that type of privatized, stay in your home, whoever you want to come in as long as you can. So the only way to really get that is to put a plan in place yourselves, obviously. So with asset-based LTC, one of the reasons we've seen such an enormous sort of increase, if you will, to this business is that we have that sort of live, die, quit, right? We have living benefits should they need their money. We have death benefits should the care never be needed, like we all hope. And we also have unlimited LTC benefits, which we'll discuss here in a minute. I mentioned that these policies can be funded in lump sums. They can also be funded ongoing, so over time. And we've seen a big increase in that business because those premiums are fixed and guaranteed, non-cancelable, and they can never be increased. So, there's a lot of folks out there who they don't want to have to sit down with their client 10 years from now and say, hey, One America, let's go over this letter you just got and your premiums are going up 50%. That will never happen with our policies. All those premiums are guaranteed, non-cancelable. We also hold a patent on the life side. We're the only carrier who can offer a true life LTC policy on a joint second to die basis to cover 2 individuals off that same policy for an unlimited period of time. So joint coverage is a patent, and we are the only carrier in the asset-based LTC world to offer and have offered the unlimited lifetime benefits LTC coverage. Most policies you'll see today, whether it's traditional or asset-based, generally are between 2 and 6 years of coverage, which for your average, quote unquote, average person, now let's remember an average is just the difference between 2 extremes, but for your average person, that is really just the difference between the person that needed 30 days and the person that needed 10 years. But what about, and what are we most concerned about? I would argue it's that client who's going to potentially need, get that dementia, have that Ronald Reagan type incident. Those are the ones that are really devastating. So if we're able to give everybody that lifetime coverage, which the perceived value from any of your clients who've had an experience, they will understand that value there. Yet if they don't, still be able to recoup their funds is just huge for us. Probably 90% of our policies, if not more, have that lifetime benefit tied to it. So to understand our policy, folks, from a high level, again, we're based on the foundation of either life insurance or an annuity, followed then by the optional rider to continue those benefits for life. So the base policy has tax advantages, and one is essentially accelerating either their life insurance death benefit or their annuity benefit tax-free for any qualifying care, including in-home. And there are various ways to fund this, like I mentioned: lump sums, annual premiums, qualified money, cash value from life insurance. So that would be the base policy, and then the rider can either be packaged as part of that incoming premium or can be purchased as a separate premium that we break out. And one of the reasons we do that, folks, is that rider, because it is not going into the whole life or the annuity chassis, it's purely true LTC coverage for lifetime. That rider is considered no different than any other long-term care insurance, and therefore could be deducted to the same extent. Or maybe you have clients that are working and they have an HSA at work. They could fund their HSA tax with pre-tax dollars and then use that money tax-free to pay the rider premium. They can break it out annually or however they want. So without getting too in the weeds, just a quick snapshot of how this looks. Here's a couple age 61 and 60. We'll right through age 80 on our life, through age 85 on our annuity. Here's $150,000 they have sitting in a CD doing nothing. You have this conversation. This is where they would probably pull from first. If they reposition this, these are real figures here, they will have a death benefit that essentially is about double in this instance based on their age. Now, could you do much better life insurance wise? Absolutely. You could work with the folks at McGill, and you could, if life and wealth transfer was the main concern, we would never be the place they would take you. So the death benefit with us is going to be minimal, but it will help overcome the use it or lose it, opposition so many people have, right? And then they can pull off this death benefit anywhere from 2 to 4% per month. Work with Nick and the team at McGill. They'll structure it based on each scenario to meet to play out best. But we do have that flexibility. And then, for example, they could add this rider to continue those benefits for a separate annual premium of $1,152, which again is considered no different than LTCI. Could be funded with an HSA, could be potentially deducted if it met those qualifications. But some people, they're just not going to want to have an ongoing premium. So in that instance, we can take the $150,000 and we can prepackage that rider and pay it up in full and just be one and done, which is what you now see on my screen. So in that instance, about $131,000 goes into the life insurance base LTC policy, and the other 18 and change pays up that unlimited lifetime benefit for free. Now, I will mention on a joint, the question your clients will often ask you, so in turn you would ask Nick and the folks at McGill is, hey, what if they both need care at the same time? A lot of people assume they would have to split that monthly benefit, and that is never the case with us. So in this example where the benefit's $5,300 a month per person for life, if they both filed claim at the same time, although not likely, we would pay out $5,300 each. So they would blow through their life insurance death benefit twice as quickly, but from a care payout, it doesn't matter because that $5,300 continues indefinitely. Do we have inflations and COLA options? Absolutely, but let's remember, folks, we're not here to cannibalize or compete with the traditional long-term care sales you may already be having. We're going after that other 90+% of people who have either said no to traditional or had it said no to them. So we're just trying to supplement the risk. We're not trying to be an end-all, solve-all. Here's what care costs today. Let's add on 3 or 5% inflation. I mean, we can work within the compounds that they feel comfortable from a funding scenario, but some coverage and supplementing the bulk of the risk is better than none, right? Or where they're at today, which is, self-funding. So when you look at this against really the four main players in the brokerage arena, particularly on a joint scenario, just nobody would be able to hold a torch to the joint coverage because, again, you have lower cost of insurance with two individuals. So all these other carriers have to break out their policies into individual policies. Again, they're 6-year benefits, not lifetime. And what really ultimately matters, I'm guessing, to you and your client is when and if a client needs some care, how much is that carrier going to write that check for, and how long will that check continue to come in? And then, as you can see here, especially on a joint scenario here, you're just never going to be able to beat what we can provide here. So that just gives you a high level. I'll end on this. When we talked about generating an income stream, one of the ways that many advisors and agents has had success is speaking in that language when they present the value proposition to their clients. So in this example, here's a 60-year-old couple. They have $125,000. They want to have that lifetime rider included, no more ongoing premiums. So what does that really do for them? Well, if you take the monthly benefit and you annualize it, it gives them $66,000 a year tax-free. So if they needed an additional $70,000 a year, like my example was in the beginning, this takes the bulk of that, at least today, off the table. If they both needed care, it'd be paying out $132,000, and this is tax-free per year. Folks, they would need to invest $125,000 at 53% after taxes to generate $66,000 for lifetime. If it was both on care, that would be obviously just double that, 106. So to speak in that language of generating an income stream to cover the largest risk that maybe hasn't been addressed in retirement tends to sit very well, we're finding with folks. So we also have annuity-based solutions. It's the same thing, so I'm not going to spend any more time. I know we're at our 15 minutes here, but ultimately it allows for old non-qualified annuities. We're one of only a few carriers that comply with the new legislation, so it pays out tax-free. So good visuals, it's very similar. They reposition partial or full 1035 of the old annuity that might have a hard time getting through compliance or suitability, just going into another annuity. Well, here, we can write this through age 85, and we can generate either a specified pool of money or a lifetime benefit. So I'll leave you with the contact for Dan Dahl over at McGill, and I'll hand it back to Nick. But I appreciate everybody's time here, and hopefully you can join us when we do our sort of mini-series, and we'll really get under the hood and dive into some of those concepts like the qualified funds and the annuities. We'll get a little deeper into there. So Nick, I appreciate your time and everybody else's time, and thank you for having me.
No, thanks, Jeremy. And as you guys can all tell, Jeremy's like a pussycat and has a very soft approach the way he handles this. And I'm very comfortable having him work with us and work with your clients. And looking forward to hearing him here in 2018, kind of diving into the weeds a little bit more. But again, we plan on keeping it a very brief 10, 15-minute webinar diving into this. If you guys need to have something immediately, please, Dan Dahl's contact info is on the screen right now. If you need to get a hold of me, please don't hesitate. But if not, I appreciate everyone's time, and we'll go from there. Thanks, and have a good day.